Okay, so Chicago real estate, right? It's kind of hard to ignore. I mean, those massive construction projects seem to be everywhere you look.
We're always building something new in this city.
Exactly. But have you ever, like, stopped and thought about how those projects actually get funded? Like, what takes a skyscraper from, just an idea on paper to a grand opening with those fancy ribbon cuttings?
It's a pretty complex process, a lot of moving parts.
Exactly. And a big chunk of that is something called permanent financing, which, to be honest, sounds a bit intimidating.
Yeah, it can be a bit of a head spinner if you're not familiar with the world of commercial real estate.
Right. Which is why we have the perfect person to guide us through this financial maze, Michael Linton.
Oh, Michael's the best. He's forgotten more about Chicago real estate than most people will ever know.
Seriously. He's been a commercial real estate broker here in Chicago for 38 years. 38 years. That's like a lifetime of experience.
He's seen it all, the booms, the busts, the everything in between. And through it all, he's helped countless developers navigate this world of permanent financing.
Which is exactly what we're going to dive into today. We're looking at this really insightful article Michael wrote. It's published on chicagodealflow.com/great site, by the way. And in this article, he really breaks down permanent financing in a way that even I could understand.
He's got a knack for making the complex stuff seem, well, less complex.
Okay, so before we get too deep into the weeds, let's start with the basics. What exactly is permanent financing?
In the simplest terms, it's the funding that kicks in once the construction is finished. It replaces that initial, usually more expensive construction loan. So imagine you're a developer, let's call her Sarah, and she just finished building this amazing mixed-use building in the West Loop. Trendy area, shops, restaurants, offices, the whole shebang. Now, this whole project cost her a cool $20 million.
$20 million. It's not exactly pocket change.
Not at all. And to get it built, Sarah most likely relied on a short-term construction loan, higher interest rates, the kind of loan that's meant to be paid off relatively quickly. But once the building is up and running, generating income, that's where permanent financing comes in.
So it's kind of like a bridge loan for big real estate projects.
In a way, yes. Construction loans get you going, but they're not meant to be permanent. Permanent financing is the long-term solution. Lower interest rates, stable payments, the kind of financial foundation that developers like Sarah need to manage their investment for the long haul.
So it's about securing the future of the project, not just getting it built.
Exactly. And that's what makes understanding permanent financing so important. It's not just about crunching numbers, it's about creating lasting value in the city.
It's the difference between, like, throwing up a building and creating a real neighborhood landmark.
Exactly. It's about thinking long-term, 5, 10, even 30 years down the road. And that's where those permanent financing deals, well, that's where they really show their worth.
So how long do these loans actually last?
Well, it really depends. They typically range from, say, 5 to 30 years, but there's no magic number.
So it's not one size fits all.
Not at all. And that's what makes it so interesting, right? Loan terms are influenced by all sorts of things. The type of property, the location, the market conditions, even the borrower's financial history. Let's go back to Sarah's project in the West Brody. Loop mixed-use development, prime location. She's got a solid track record. She could probably secure a loan term of, say, 15 years, maybe even longer. But if we're talking about, let's say, a retail space in a less established neighborhood, the loan term might be shorter, maybe 10 to 12 years, to reflect that perceived risk.
So location, location, location. It applies to financing, too.
You got it.
Yeah.
Lenders, they want to see stability, a proven track record, especially in a dynamic market like Chicago.
So it's all about managing risk.
Absolutely, and that's where interest rates come into play. Now, remember how Sarah snagged that sweet deal in the West Loop? Well, she managed to lock in a fixed interest rate of 3.75% for 15 years. That move alone significantly reduced her monthly payments. We're talking a 20% decrease compared to that initial construction loan.
Wow, that's huge.
It's a game changer. Now, if this were that hypothetical retail space in a less established neighborhood, the interest rate might be a tad higher, maybe 4.25% or even 4.5%, to account for the perceived difference in risk. Lenders, they love to see those prime locations with a history of strong performance.
So the better the location, the better the loan terms.
Generally speaking, yes. A prime location can translate to lower interest rates, longer loan terms, even more favorable loan-to-value ratios, but that's a whole other topic we can dive into.
Loan-to-value ratios, that's another one of those real estate terms that make my head spin a little.
I hear you. Don't worry, we'll get to that. But essentially, it all boils down to this. Location matters.
It always seems to, doesn't it? Whether we're talking about property value, rent prices, or even, it seems, the terms of your financing.
It's all interconnected. Chicago's real estate market is like a giant puzzle with all these pieces influencing one another. But before we get lost in the weeds, we should probably unpack some of these concepts a bit further, like those loan-to-value ratios you mentioned.
Right, let's do it. And there's another one I remember you mentioning earlier, DSCR.
Ah, yes, the debt service coverage ratio. Now, that one might sound a bit intimidating, but it's actually a pretty simple concept.
Okay, you're the expert. Break it down for us.
DSCR is all about making sure the property can actually pay for itself. It's basically a way for lenders to assess the financial health of a project. They want to see that the income generated by the property, those rent payments, those lease payments, whatever it might be, can comfortably cover the debt obligations, those monthly mortgage payments.
So it's like a financial stress test for the building itself.
Exactly. And in Chicago, lenders usually like to see a DSCR of at least 1.25. So if a property's net operating income, that's the income after expenses, is, say, $125,000 per month.
Okay, I'm following so far.
That property could comfortably support monthly debt payments of up to $100,000 while still maintaining that healthy DSCR of 1.25. It's all about making sure the numbers add up and giving lenders the confidence that their investment is secure.
So DSCR is like a financial safety net for everyone involved.
Precisely. It's a win-win. Lenders feel more secure about their investment, and borrowers like Sarah have a clear roadmap for managing their debt and ensuring the long-term success of their project.
So we've got loan terms, interest rates, loan-to-value ratios, DSCR. It seems like there's a lot to consider when it comes to permanent financing.
There is. But the good news is that Chicago offers a whole bunch of different permanent financing options to choose from, each with its own quirks and advantages. It's not a one-size-fits-all kind of situation, which is why understanding your options is, well, it's crucial.
Okay, now you've got me intrigued. Let's break down those different types of permanent financing options available here in Chicago. So many options, right? It's like walking into a massive real estate buffet. Where do you even begin?
Well, you always got to start with the classics. In this case, that would be traditional bank loans.
Right, the familiar faces in the neighborhood.
Exactly. We're talking about your local banks, those big national players. They're all active in Chicago's commercial real estate lending scene. They're often a good starting point for borrowers, especially those with a solid track record.
It's all about relationships. Right?
Exactly. Banks, they like to see that you're a reliable borrower, someone who pays their bills on time, someone who understands the market. And of course, they're looking at the property itself, the location, the potential for generating income. But if you've got a good story to tell and the numbers to back it up, traditional bank loans can be a very attractive option.
They offer that sense of familiarity and stability.
Absolutely. Now, on the other end of the spectrum, we have CMBS loans.
CMBS, right. I remember you mentioning those earlier. Those are for the big fish, right?
You could say that. CMBS stands for Commercial Mortgage-Backed Securities. Essentially, these loans are bundled together and sold to investors as bonds.
Okay, so it's getting a bit more complex.
A little bit, but stick with me here. The beauty of CMBS loans is that they can handle much larger loan amounts. So if you're talking about financing a skyscraper, a shopping mall, a massive mixed-use development, something that would make those traditional banks a little bit nervous.
Right, those multi-million-dollar deals.
Exactly. That's where CMBS loans often come into play. They provide that extra firepower for those really big-ticket projects.
So higher risk, higher reward.
In a way, yes. CMBS loans often come with higher loan-to-value ratios, meaning the borrower can potentially secure a larger loan compared to the property's value. But of course, there's a trade-off. These loans can be more complex to structure, and the interest rates might be a bit higher compared to, say, a traditional bank loan.
So it's about finding that balance, that sweet spot between risk and reward.
Precisely. Now, let's talk about another type of lender that's been gaining traction in the Chicago market: life insurance companies.
Life insurance companies. They're in the real estate game, too.
Oh, they sure are. And they've got a unique perspective, that's for sure. Life insurance companies are all about long-term investments, and they're drawn to those stable, predictable returns. Remember how we talked about those DSCR ratios earlier?
Right, making sure the property can cover those debt payments.
Exactly. Life insurance companies, they love to see those healthy DSCR ratios. It gives them that peace of mind knowing that their investment is, well, secure.
So it's a good fit for both sides. The borrower gets their financing, and the life insurance company gets that long-term, stable return.
Exactly. It's a match made in, well, maybe not heaven, but definitely in the world of commercial real estate.
Right. So we've got banks, CMBS loans, life insurance companies. That's already quite a variety.
And we're not done yet. There are a couple more options to explore. Have you ever heard of Fannie Mae and Freddie Mac?
Oh, yeah. Those names are hard to miss. I feel like I see their commercials every time I turn on the TV.
They're the big players in the residential mortgage market. But what many people don't realize is that they're also active in commercial real estate lending, particularly when it comes to multifamily properties.
So those new apartment buildings popping up all over the city, those could be financed by Fannie Mae and Freddie Mac.
They very well could be. These agencies, they provide a ton of liquidity to the market, making it possible for developers to secure financing for those large-scale apartment projects. They're essential for meeting the housing demands of a growing city like Chicago.
Okay, so they're kind of like the unsung heroes of the housing market, making it possible for people to find affordable places to live.
You could say that. And they also play a role in financing those mixed-use developments that are becoming increasingly popular. You know, those buildings with apartments, shops, restaurants, all in one convenient location.
Right, those are everywhere these days. It's like living in a mini city within the city.
Exactly. And Fannie Mae and Freddie Mac, they've been instrumental in making those projects a reality. They bring a certain level of stability and affordability to the market, which is always a good thing.
Absolutely. So we've covered banks, CMBS loans, life insurance companies, agency loans. Is there anything else? Or have we exhausted the options?
Well, there's one more category we should touch upon, and that's SUDFHA loans.
Okay, HUD, FHA. Those sound familiar, but I can't quite place them.
HUD stands for the Department of Housing and Urban Development, and FHA is the Federal Housing Administration. They're both government agencies focused on, well, you guessed it, housing.
So we're talking about government-backed loans. Are those like those VA loans I hear about, but for real estate developers?
Kind of, yeah. But instead of helping veterans buy homes, HUD and FHA loans are all about creating more affordable housing options for everyone.
Okay, so these are the loans that help make those projects in like underserved communities a reality.
Exactly. They're designed to incentivize developers to take on projects that might not be as commercially viable without a little help from the government. These loans often come with more favorable terms, you know, lower interest rates, maybe even some flexibility with those down payment requirements. It's all about creating more equitable housing options across the city.
So it's not just about the bottom line. There's a social impact component to these loans as well.
Absolutely. It's about recognizing that a healthy real estate market benefits everyone, not just those who can afford those luxury high-rises.
Makes sense. So we've covered a lot of ground here. Banks, CMBS, life insurance, agency loans, HUD, FHA. It seems like there's a financing option for every type of project and every type of borrower in Chicago.
Exactly. Chicago's real estate market is incredibly diverse, and so are the financing options available to developers. But knowing the players is just the first step, right?
Right. So what are some of those key takeaways that developers or really anyone interested in Chicago real estate should keep in mind when it comes to navigating this world of permanent financing?
Well, Michael Linton really hits the nail on the head in his article when he talks about the importance of timing. You know, in real estate, timing is everything.
It's like they say, buy low, sell high.
Exactly. But it's not just about buying and selling properties. It's also about securing the right financing at the right time. If you wait until the last minute to start exploring your options, well, you're likely to find yourself in a much weaker negotiating position.
Less leverage, fewer options, not a good place to be.
Not at all. Starting early, doing your homework, understanding the market, those are the keys to securing a favorable permanent financing deal.
So don't procrastinate.
Exactly. Another piece of advice Michael emphasizes is knowing your property's worth. I mean, really knowing it, not just relying on some online estimate you found.
Right. Those can be way off sometimes.
Absolutely. Get a professional appraisal, one that takes into account all the factors that contribute to a property's value. The location, the condition, the potential for generating income. Knowing your property's true worth gives you a realistic understanding of your borrowing potential, which is essential when you're negotiating those loan terms.
So knowledge is power. The more you know about your property, the better equipped you are to navigate the financing process.
Precisely. And speaking of knowledge, Michael also talks about the importance of staying informed about market trends. Chicago's real estate landscape is constantly evolving. What's hot today might be lukewarm tomorrow.
He's right, this city never sits still.
Exactly. Remember our discussion about industrial properties earlier?
How could I forget? It seems like everyone's trying to turn an old warehouse into the next trendy loft space.
Exactly. And that's a great example of how market trends can impact financing. A few years ago, those industrial properties were, well, not exactly sought after. But then e-commerce exploded, the demand for warehouse space skyrocketed, and suddenly those overlooked industrial properties were, well, the hottest thing since sliced bread.
It's like predicting the stock market, trying to anticipate those shifts and capitalize on emerging opportunities.
That's a great way to put it. And that's where having a local expert on your side can be invaluable.
Right. Someone who really knows the ins and outs of the Chicago market.
Exactly. A seasoned broker, someone who's been around the block a few times, they can provide invaluable insights and guidance. They can help you navigate the complexities of the financing process, connect you with the right lenders, even negotiate those loan terms on your behalf.
So finding the right broker can make all the difference.
Absolutely. They're like your real estate Sherpa, guiding you to the summit of that financing mountain. They've seen the treacherous paths, they know the shortcuts, and they can help you avoid those costly missteps.
So if you're feeling a bit overwhelmed by all of this, don't hesitate to reach out to a local expert.
Exactly. They're there to help. And finally, and this is something Michael emphasizes throughout his article, it's crucial to have a clear vision for your project and how permanent financing fits into your long-term goals.
Right. Don't just think about the next 5 years, think about the next 25 years.
Exactly. Are you planning to expand the property down the line? Maybe convert it to a different use? Those decisions will have implications for your financing, so it's crucial to have a plan, a roadmap for the future of your investment.
So permanent financing, it's not just about securing a loan, it's about securing the future of your project.
Precisely. It's about creating that financial foundation that allows you to adapt to changing market conditions, capitalize on new opportunities, and ultimately maximize the value of your investment. It's about turning that vision, that dream of owning a piece of the Chicago skyline into a lasting reality.
It's about making your mark on this incredible city.
Exactly. And that, my friend, is what makes this whole world of permanent financing so fascinating. It's not just about crunching numbers and signing papers. It's about shaping the future of Chicago, one building, one project at a time.
It's about taking those ambitious ideas, those grand visions, and turning them into something tangible, something real, something that contributes to the fabric of this city.
Well said. Well said.
Well, that just about wraps up our deep dive into the exciting, complex, and always evolving world of permanent financing in Chicago's commercial real estate market. A huge thank you to Michael Linton for sharing his incredible insights and expertise with us today. For those of you eager to delve even deeper into this topic, and I know you're out there, be sure to check out Michael's website, chicagodealflow.com, a treasure trove of information for anyone interested in Chicago real estate. Until next time, keep exploring, keep learning, and keep diving deep into the fascinating world around us.